These are trading patterns that you must know. Use this video as a guide all throughout your trading career to understand and refresh yourself on these 5 patterns. Pattern number 1, it's what I call the ugly face. Now, why is it called an ugly face? Well, if you look here at Google, it's actually forming an ugly face right now. You have what actually kind of starts to begin to look like an ugly face. You have your eyes here and you have your mouth. Now, what does that indicate? Typically, when you see an ugly face pattern, you are going to get 3 different pieces of it, resulting in the stock coming down to the previous support level, maybe sometimes even beyond. So let's clear this out and draw the 3 pieces. Number 1, the stock price rallies up, and it's typically going to rally to 52-week highs or all-time highs, something that is a new high that's being created, that's creating a lot of excitement and pushing this stock up. And at some point, the stock price is going to stop and it's going to level off somewhere. After it levels off, the excitement is done. Maybe people are taking their profits. Your stock price is going to start to wither down. And it's not going to be an instant fall, as you're seeing here with Google. Remember, guys, this is just earnings, so don't think about it that way. But you're going to see your stock price gradually start to fall over many, many weeks. And eventually, it's going to hit some kind of trough. Now, when you see that happening in real time, you should say to yourself, now what I need to see here, or what I'm looking for to be a bearish signal, is my stock price to rally back up and level off at that same price as the previous high. It could have been a month ago, could have been 2 months ago, but it's going to hit that same level. And you see here, Google on Monday, April 1st, tried to push through, but it actually failed, and it's right back to that point. So that's your 3rd piece of it. Now what happens? Now, when you usually see this, you start to see a gradual fall in price. And it typically will fall below or to, it'll drop down to here, which is the next support level, or here, or in many cases, it drops well below this support level. So here's what I encourage you to do when sitting at your computer in the morning. I encourage you to go in and look for ugly face patterns. Go and see them happening in real time. And as we flip through more examples here, I might catch an ugly face pattern and say, oh, here's a good one that you need to pay attention to. You're going to see that fall. But ugly face patterns happen so often in this market, especially when highs are being created. They cannot break above that big support level to break to new 52-week highs, new all-time highs. And what happens? The stock runs out of steam and it falls right back down. One question that I often get: how wide can an ugly face be? Because I said 1 month to 2 months. There's actually many chances where you're going to see an ugly face pattern that can result in a year's span. So now I will caveat it with this: they will be weaker because there's so much built up support and resistance in that time frame that it's not going to say, oh, this is such a tight frame. Like right here, if I'm looking at Google in the time frame that we pointed out, I think that this will fall pretty hard. It'll probably come back to this $130 level from 152. Now, looking over here, August of 2022 to May of 2023. That's a very wide range, and it still is an ugly face pattern. I should probably draw it like that. It still is an ugly face pattern. But because, let's clear this out, because there was so much support built up in there, if you could just see the lines that I'm drawing. So you have a lot of consolidation here. This was a ton of consolidation that was acting as a strong support level on the way down. It's going to be very hard for this stock price to fall through 1, 2, 3, 4, and so on levels. This had happened very quickly. So there's not a lot of support built in there. So the wider the face is, the harder it's going to be to fall. So if you see something that rallies up really quickly, this is a great example right here. Something that rallies up really quickly, creates an ugly face, and boom, you can see it fell below this level. Number 2, this is called the head and shoulders pattern. And I'm going to tell you a quick story. This was a pattern that was very difficult for me to recognize. I had a mentor who would teach me about trading, and every time I would lose money, I would recognize that I was buying into a head and shoulders pattern, and it just didn't make sense to buy. So this is something that takes a second for somebody to see, but once you see it, you really can't unsee it. And I'm going to use Google as an example again. So head and shoulders pattern really is, you have your head here, or your peak price, and you have 2 shoulders. So what is let's draw it again like we did in the first example. Well, you have a stock price that kind of rallies up and falls a touch and rallies again. And it kind of creates that shoulder right there. And the head is the peak or the new high, the 52-week high. Then it starts to fall back down. And again, we have earnings in here, but think about it this way. It falls back down and rallies up a little bit. It rallies up a little bit, and it creates what looks like another shoulder. So if I was any type of an artist, I would be able to draw kind of a body with two shoulders right there. This is almost your neck, and you can tell that I'm a great artist. So here's your hands over here, and your feet would be down here. But most important part, here is your head and shoulders. Now, what does a head and shoulders indicate? And why is it so hard to recognize? With an ugly face, it's easy. You realize, here's your peak, here's your peak. It's pretty easy to see that you're running into a previous resistance point of a high, right? Now, on an ugly face pattern, it's a little more, on a head and shoulders, it's a little more challenging because you have to pick out the shoulder. You have to recognize that this is the peak, which is not hard, but then you have to decide, then you have to say, okay, I have a feeling that this is gonna be a new resistance support level that's gonna happen, that's gonna kind of hit that thing and fall back down. And what happens when head and shoulders are created? It's the same thing as ugly face patterns. Here's your head, here's your shoulder, and what happens? The stock price falls well below your head, your two shoulders of the body. That is a pattern that is very tough to recognize because a lot of people will look at this and you can't really see anything in here unless you're trained. You'll look at this and say, oh, well, the stock price is going right back up. Or you'll look in here and say, well, stock price is going right back up. I'm going to buy. And it runs into this, that resistance level. And boom, that happens. And people say, why do I lose money? Because you bought into a head and shoulders pattern. Okay, the next one. This is called a 50% rule. And Boeing is the perfect example of a 50% rule in this market. It is quite unbelievable when you start to zoom out and see what things are. Also, CCL, Carnival Cruise, is a great 50% rule. So I'm going to show you Boeing, then I'm going to show you an example of when I actually used the 50% rule to my advantage, sold and made money. So looking here, you have, this is pre-COVID up here. You have your high. Boeing went to these crazy, crazy highs. And in COVID, it dropped to these crazy, crazy lows, sub $100. So it went from almost $450 to $100 in a matter of no time. Now, what is the 50% rule? 50% rule is the line right in the middle. It's half of returning to the high from the very bottom. Now, all of this black area here, this is what I call overhang. It's the area where you just have negative pressure pushing down on the stock. It's very tough to break through that level. And you can see here, this is 2020. This is 2024. It has not broken through this 50% rule line in 4 years. Why is that? Well, here's what happens. The people that are in the stock up here, they're really excited and they're making money, and all of a sudden, boom, they lose a ton of money and the stock price falls from, call it 400 and all the way down to 100. And they say, you know what? I just lost so much money. If I could just get half my money back, I'll exit this thing and I'll move on. Well, the stock price rallies up. It gives you opportunities to sell here, here, and here. They got back half their money. They're happy. What are they going to do? They're going to sell their shares. And what happens when they sell their shares? Well, the stock price just falls back down. And you can see in here, it rallies back up and people say, man, I didn't get an opportunity to sell there, so I'm going to sell here. And what happens when everybody sells here? It falls back down. These people, I didn't get an opportunity to sell here or here. I don't think this is going to go back up to 400. I don't even think this is going to go past 275. Well, I'm going to sell here. And you can see the trajectory that just continues to fall down. Eventually, in this case, 4 years later, the stock price starts to climb. And look what happened here, guys. The same area that you hit here in February/March of 2021, you hit the exact same peak in October, November of 2023. Isn't that crazy? And that is why the 50% rule is so powerful. And look what happened to the stock price. It has fallen back sub 200 and it wasn't able to break that 50% area. 50% is such an important thing to recognize. All you have to do is zoom the chart way out. You notice here, I'm going back to 2013 just to see how far we're going here. That's 11 years ago. Now let's go to CCL. CCL is actually one that I used. Actually, I used it on Boeing too. Let me go back to Boeing. So I bought Boeing back in 2020 when all of this was happening. And I ended up selling, it was either here or here, I can't really remember, but I sold because the 50% rule was being created. Now let's go to CCL. CCL is an exact similar situation. So you have exact similar, that's funny. Here's your peak, here's your trough, here's your middle line. That's your 50% area. Here's all that overhang that's pushing down negatively on the stock. The stock price falls, it rallies. People say, okay, I'm just going to get some of my money back, and it falls back down. And here is when I actually ended up selling. I can't remember the exact date, but I remember recognizing that the 50% level was about $30 a share. And I think I missed it here, and I missed it here, and I think I sold right around here. I sold right in there below the 50% line, or at the 50% line. And then look what happened afterwards. It has not even sniffed $30 a share since. Why did I sell? I literally sold because it couldn't eclipse that 50% rule. If it eclipses it, great. Then you buy back in. If it doesn't, you're kind of just stuck and it's just going to beat you up. So why not take advantage of knowing a rule that's going to save you a lot of money in the long run? The next pattern to know is the tweezer pattern. Tweezer patterns are tricky to recognize to the untrained eye. A lot of these are, but this one more so than any of them. What you're looking for is basically, let me draw this, basically a candle, very small candle, with a big wick on top, followed by a second day, doesn't need to be exactly the same, I'm just doing this for illustration purposes, followed by a second day in a row with a long wick on it. And what does that typically indicate? Well, it indicates a reversal or a change in direction of the stock price. And these ones are tough because a lot of people look at them and say, I have 2 days with a wick, it's no big deal, I'll get the stock price to go up the next day. Not recognizing that it's actually a tweezer that's happening. So if we look here on Google, I have these 2 days right here. And you're probably looking at this saying, how the heck did you go back and see that? I went back and saw that because I'm able to, what I do is I go through probably 100 stocks per day at this point. Back when I started, I was going through 500 stocks per day, looking and saying, okay, what do I need to do to make money in this market? What kind of training do I need to do? And I recognize I have 2 candles here. Let me turn this off. 2 candles here with wicks on them. And what does that mean? It means, to me, it tells me that there's a really good chance, a really good probability of a change in direction happening. And look what happened. Boom. Change in direction happened. If you go through and look for tweezer patterns like this, I guarantee you that you're going to start to see, when you see multiple days in a row with uncertainty, meaning 2 long wicks sticking up, you are going to see the stock price pull back in the subsequent days. Now, a final pattern that is very, very important, and often people will lose money here because they buy too early or they sell short too early. It's called the trap door. Now, what the trap door is, you look down here at your 2 trend lines and you have your red and your yellow. And this one, obviously, we're looking to go maybe long on this because you're looking for like a reversion, so to go to the top. But you notice here, these lines just converted. And actually earlier today, if I am being honest, the red line was under the yellow and it kind of had this, let me get rid of my whiskers here. It kind of had this little tiny gap between the 2. And that right there is called the trap door. So if you kind of just get rid of that and you just look at the red and yellow being open just ever so slightly, that's the trap door. Now, why is that important, or why is it called the trap door? It's called that because let's say you have 2 lines that are converting like this and you're trying to get them to revert or to go over top of each other. What you would ideally see is this bottom line come up here and this top line kind of go through and cross, and they create a positive trend. Or it could be a negative trend. It doesn't matter. Just those 2 lines in relation to each other. Now, what will happen is they'll get awfully close like this. And it looks like what's going to happen is one's going to go on top of the other. But what will actually happen? And so let's back this up. It looks like they're going to cross. And what are you going to do? You're going to go in here and say, you know what? I'm going to buy this bottom line, which I'm going to draw in red, and I'm going to go long on it because I know what's going to happen. This is going to go there, and this is going to go there, and we're going to be happy, and it's going to be a long position, and I'm going to make money, and the stock price is going to go up, and it's going to be great. But what actually happens? What actually happens is the lines don't cross each other. The red line continues to go down, and the yellow line stays on top of it, and the short continues. The trap door is important for waiting 3 days. So if I get something that is entering the sweet spot, and remember, the sweet spot's between these two lines. It gives us the highest probability to make money. I want the trap door to be closed. So I want the red line and the yellow line to cross and remain crossed for 3 days before I actually take a position. I want to make sure that that thing is solid. So anytime that you see a little gap just waiting between the red %K and %D, red and the yellow line, you need to be very cautious and say, okay, I need to make sure that trapdoor slams shut and not on my body. The idea is that the trapdoor will slam and just crush you, and it'll just continue on. You want this thing to slam shut behind you so you're clear and you can move forward with your trade. Now, a great question came from my producer when I was doing this video. Mo, you talked about all these great patterns. What charts are we using? This is for your daily chart and your long-term chart. This is not for day trading. These types of patterns you only look for when you're on your daily chart and your long-term chart. I want you to use this video as a reference guide to keep coming back to. Watch it over and over and use it as a refresher. Watch it once a week. It will benefit you so much. So if you want more learning like this, join my Patreon. It's $25 a month right now, forever, but there's only 100 spots available. You'll get to trade with me live and see my live trades twice a week and have full access to me in the chat. Now go watch this next video on the bid-ask difference. It's another little tip that's going to make you save and make a lot of money.